All right, so there may finally be some good news on the horizon for potential home buyers moving into 2024, at least according to this report out of Resi Club by Lance Lambert. Now, he bases this article off a 59-page report provided by Morgan Stanley that was sent to investors, and it details their view on the U.S. economy, the housing market, and the bond market moving into 2024. And the best part about this is that they believe, their base case anyway, is that the housing market is poised for an improvement in affordability that we've only seen a handful of times over the past 35 years. Now, they go into detail as to how they came to that conclusion, so you're going to want to see that, but you're also going to want to see exactly what that would do to the monthly payment for the median priced home. But before we jump into the details of this report, if you would please consider liking and subscribing. It really helps grow and promote the channel, and I would certainly appreciate it. Next year, Morgan Stanley analysts believe that the U.S. economy will avoid a recession, incomes will continue to rise, mortgage rates will decrease slightly. They expect the 10-year Treasury yield to go down to 3.95%. We are currently at about 4.4%, and they expect home prices to fall by 3%. So there's a lot to unpack here. Now, they basically anticipate that the three levers that impact housing affordability are all going to be pulled in a little bit together, which would create a significant improvement in the housing market. Let's go ahead and unpack all of this, starting with mortgage rates. Now, Morgan Stanley believes that the 10-year Treasury yield will drop to 3.95%. At the time of this recording, the spread between the 10-year and the 30-year fixed rate mortgage is about 300 basis points. So if in fact the 10-year were to come down and that spread were to remain where it is today, which is historically high, by the way, we would see mortgage rates drop down to about 6.99%. If that spread narrows and returns to a more normalized level, somewhere between 150 and 200 basis points, we're likely to see interest rates fall maybe even to the upper 5% range or low 6% range, which would be a dramatic improvement in affordability from where we are today. If we move on to housing prices, Morgan Stanley's base case is that we'll see a 3% reduction in the median home price. If we're sitting at around $400,000 today, this would bring the new median home price to $387,000. In addition to that, they believe that incomes are going to rise. And if those were to just keep pace with inflation, this will bring a significant improvement overall to housing affordability. Let's take this a step further and identify what this would do to the monthly payment. At the peak, we had a median home price around $400,000. Rates are at about 8%. This is with 20% down, accounting for taxes and insurance. We had a monthly payment at $2,913. If Morgan Stanley's base case is accurate, the new median price would be about $388. We'd see mortgage rates at about 6.99%. We'd account for taxes and insurance. Taxes would be lower, by the way, because the purchase price is lower. And that would bring the monthly payment to $2,567, which is about a $346 a month savings. Now, if you're curious as to how Morgan Stanley analysts explain this logic, here it is. The immediate response in the housing market to spiked mortgage rates has been renewed decreases in inventory. Essentially the lock-in effect. Sellers don't want to trade a 3% rate for a 7% rate. And of course, because of this, they believe that this provided the support for home prices. Now, as rates come down throughout the year, we would expect affordability to improve and for sale inventory to increase. Both of these developments are constructive for housing activity, but the latter, meaning increased inventory, provides a potential counterbalance for those home prices. We expect housing activity to be stronger in the second half of the year, and new home sales are going to increase more than existing home sales over the course of the full year. Home prices should see modest declines as the growth in inventory offsets the increased demand. In my view, this all around is good news for the potential homebuyer. If we see mortgage rates come down, hopefully that will entice some more sellers to bring housing inventory to the market, and it will improve affordability, bringing more demand in for buyers. If we see that supply continue to outpace the housing demand, then buyers are ultimately going to be getting better deals. Aside from Morgan Stanley's base case, in this report, they also put together a bull case for home prices going up and a bear case for what would happen if home prices went down even further. I think it's important to note, let's go ahead and take a look at what they said here. Morgan Stanley's bull case is that home prices would rise about 5%. With so many housing statistics at levels that we rarely seen over the past several decades, it isn't hard to envision housing activity and home prices evolving differently from what we have laid out above. As mortgage rates come down, affordability will remain under substantial pressure. However, a consumer that has recently seen mortgage rates above 8% might jump at the chance to lock in at 6.5% or 7% mortgages in far greater numbers than we are expecting. If demand increases more than we are expecting into the supply environment that remains constrained, we envision home prices climbing further, approximately 5% next year, to a new record high. In my view, this would ultimately depend on the market that you're in, because some of these markets have gotten wildly disconnected from the local wages, whereas others fall more in line. So I think this is going to be extremely market specific if that scenario were to play out. The deeper bear case here is that they see home prices decline by about 8% if rates remain elevated, or the economy does slip into a recession. Demand could soften further into 2024. While we do not believe that the defaults and foreclosures and thus distress transactions will increase significantly in this cycle, and especially not in 2024, a lot of times this stuff takes a year or two to even play out. If any defaults or foreclosures were to happen, likely we would not see any of that until 2025. But any increases in supply into a weaker demand environment will likely weigh on prices. Older homeowners or any capitulation from households that have simply lived in their homes longer than they originally anticipated would likely drive prices down in excess of our. That's going to wrap it up for this video. We would love to hear from you. Where do you think home prices will go in 2024? Please leave it in comments below. And if you got anything out of this video, consider liking and subscribing. It really helps grow and promote the channel, and I certainly appreciate it. Take care.